I'm Daniel.
And I'm Mira.
So today, major U.S. equity indices suffered a pretty volatile retreat from their early July peaks. I mean, they basically surrendered all their early session gains to finish right near the lows.
Yeah, and meanwhile, you have this violent whipsaw in crude oil and escalating global blockades setting a really tense backdrop.
Right. So today we're going to unpack the overnight geopolitical brinkmanship, break down those sharp intraday market reversals during U.S. trading hours, and review some major tech infrastructure financing moves before we look ahead to tomorrow's earnings slate.
It is a totally packed deep dive today.
It really is. But before we dive in, just a quick reminder for you, the listener. This deep dive is for market context and discussion only. It is definitely not personal investment advice or an investment recommendation.
Exactly. So let's get into session one. What set the stage before the U.S. session?
Well, I mean, to really understand today's anxiety, you kind of have to look at last week's unresolved drivers. We already had this tech sell-off tied to AI CapEx scrutiny, right?
Yeah, and sitting right on top of that is the Warsh Fed's hawkish baseline.
Which means we're still operating in that landscape of central bank demand destruction against supply inflation.
Right, so the Fed is trying to cool demand, but supply shocks just keep pushing prices back up. And those supply shocks really escalated overnight into Monday.
Yeah, absolutely did.
The U.S. completed a 9th straight night of military strikes by Sunday at 10 p.m. Eastern Time, hitting Iranian cities like Tabriz and Chabahar.
And the retaliation for that was, immediate.
Yeah, Iran's Revolutionary Guard struck U.S. bases in Kuwait and Jordan, plus installations in Bahrain. That actually caused casualties in prefabricated housing units.
It's really tempting to look at these events as, like, unpredictable natural disasters just shaking up the market. But if you apply a game theoretic lens, it looks a lot more like calculated brinkmanship.
Hey.
Well, despite the severe military exchanges, mediators are concurrently proposing a 10-day ceasefire to revive the U.S.-Iran interim deal. And Iran actually sent its foreign and interior ministers to Pakistan for talks.
Oh, right.
Yeah, so you don't send senior ministers to negotiate if you've lost control. It suggests they're trying to force leverage at the negotiating table, even while the Trump administration remains publicly skeptical.
And that brinkmanship is definitely widening the conflict. At 5:02 a.m. Eastern Time on Monday, Yemen's Houthi rebels announced a complete sea navigation ban on Saudi Arabia in the Bab el-Mandeb Strait.
Wow, a full ban.
Yeah, they're threatening full-scale war if the siege on Yemen isn't lifted. So that's another, massive global shipping choke point essentially blocked off.
Which is just a nightmare for supply chains. And while that's happening, at 6:16 a.m. Eastern Time on Monday, UK Prime Minister Keir Starmer just suddenly resigned.
That was incredibly fast.
Very. Andy Burnham became the new PM, but he immediately recommitted to their fiscal rules. So the market reaction was actually super muted. The FTSE was down just 0.71%, mostly on just broader risk aversion.
Which is quite a contrast to the global inflation picture. At 8:30 a.m. Eastern Time, Canada's June headline CPI slowed significantly down to 2.8%.
Right, which really supports that whole global monetary easing narrative outside the U.S.
Definitely.
So you take this cauldron of supply chain threats and global policy shifts, and it created this highly defensive posture heading right into the New York Open. We're going to take a short break, and then we'll be right back with session 2.
Stay with us.
All right, we're back with session 2. What moved markets during U.S. trading hours?
Well, the U.S. equity market had a really sharp reversal intraday. The S&P 500 futures actually rallied initially.
Right, they hit a session high of 7,552.
But then they just collapsed, closing at 7,483.25. And the NASDAQ basically followed suit, dropping down to 28,778.
And the main driver there was really oil's wild ride. I mean, Brent crude had a massive intraday swing.
It was huge. It surged to $91.43 on those escalation fears.
But then it plunged to $86.14, probably on whispers of that 10-day ceasefire proposal.
Exactly, before finally settling relatively flat at $88.97.
A crazy whipsaw. And how did the bond market react to all that?
Very strongly. The 10-year Treasury yield climbed to 4.598%, which obviously boosted the U.S. dollar. We saw investment-grade and high-yield corporate bonds slide intraday.
Right. LQD and HYG were down.
Yeah. But it's important to remember that frame we always talk about credit stability signaling a non-systemic duration shock. Corporate spreads remain historically tight despite the equity multiple compression.
So the companies aren't, going bankrupt en masse. Their debt just got cheaper because underlying yields went up.
Exactly. It's a rate issue, not a solvency issue.
Then at 3:40 p.m. Eastern Time, President Trump signed an executive order forcing defense contractors to map their critical mineral supply chains.
And they have to prioritize domestic products, right?
Yeah, threatening the loss of federal contracts for non-compliance. And he tied lower aluminum tariffs to explicit onshoring plans.
But, I really have to challenge the direct market impact of this policy for today's session.
Oh, why is that?
Well, the materials and industrial sectors closed down 1.2% and 1.4% respectively, but they were already trading lower right from the cash open.
That's true. They were down early.
So you have to wonder if this domestic supply narrative was already priced in, or if it was just totally overshadowed by the much larger Middle East macro shock.
That is a really fair point. The timing makes it super hard to untangle.
It really does. So basically, rising yields and these geopolitical whipsaws drained all the market's early optimism today. Let's take a quick break before we jump into session 3.
Sounds good. We'll be right back.
And we are back.
All right, session 3, corporate events recap and what to watch next.
Let's start with the physical build-out of AI because the CapEx and hardware diversification we're seeing is huge.
Oh, it's massive. Meta had a huge capital raise today. At 2:17 p.m. Eastern Time on Monday, BlackRock units planned a bond offering of over $12 billion.
$12 billion?
Yeah, for Meta's data center campus in Texas. It basically proves that hyperscalers still have massive, unimpeded access to capital pools for physical infrastructure.
That's incredible. And we're seeing hyperscaler hardware diversification to fill those data centers, too. Late Sunday at 11 p.m. Eastern Time, Microsoft announced a partnership with AMD.
Right, to deploy their next-gen Instinct and 6th-gen EPYC processors in Azure.
Yeah, and then Monday morning at 9:03 a.m. Eastern Time, reports surfaced that Google is developing a new custom server chip to run its Gemini models more efficiently.
Which is a huge structural threat to traditional chipmaker margins. I mean, they're all trying to build their own silicon now.
Exactly. And on the regulatory side, at 6:01 a.m. Eastern Time on Monday, Alibaba was hit with a record €550 million fine by the EU under the Digital Services Act.
Ouch. €500 million is a heavy compliance headwind.
It really is. So, with indices reversing hard and Brent crude bouncing around like a pinball today, we really hope your portfolio survived this geopolitical obstacle course.
Seriously.
On the bright side, at least U.S. defense contractors are now forced to map their domestic supply chains, meaning the only thing harder to find than a cheap AI chip is a federal waiver for foreign minerals.
So true.
And if you're feeling bruised, just remember your stock positions probably lasted longer today than Keir Starmer did in Downing Street. At this rate, we might need the new UK Chancellor to hedge our emotional portfolios. Let's hope tomorrow brings a little more easing and a lot less escalation.
I think the whole trading floor would second that motion.
Yeah.
So looking ahead to the next 24 hours, what should we actually be watching?
Well, overnight into Tuesday, the absolute primary risk for crude, treasuries, and credit remains any U.S.-Iran ceasefire developments or any fresh physical disruptions in the Strait of Hormuz and Bab el-Mandeb.
And then for Tuesday pre-market earnings, it's a huge slate. We have Halliburton, which is going to be a key read-through for North American oilfield activity and energy capex.
We also have Northrop Grumman, so we'll get a direct read on defense spending and geopolitical risks.
Right. Plus General Motors for consumer demand, tariffs, and supply chains. And finally, Charles Schwab and Capital One for banking and consumer credit conditions.